everybody. My name is Tunji. Just you can call me Tunji for short. And I will just be taking us through the accounting overviews and best practices. Basically, trying to understand what are the fundamentals of accounting. Why do we need accounting? What's the essence of even having accounting uh, and bookkeeping and keeping your books in the first place? Why do I need to? We hear a lot of people talk about bookkeeping and all that kind of thing, and everybody just keeps it on the back burner. You have businesses to run. You're focused more on how to make profit, how to make your products have high quality. But one of the fundamentals that we keep forgetting is that I always tell people figures don't lie. You need to capture your information. You need to understand if you're even making a profit, if you're able to even break even at the end of the day, for tax purposes, for record purposes, and all that. Um, I'd like an interactive session. If, as I'm going through, you have questions, please stop me and ask the questions. Even though there's a space at the end for us to ask questions, we don't have a lot of people on, so we can ask questions that relate directly to your business and areas where you need additional clarifications.
Great. And also, I'll monitor the chat as well. If anybody wanted to type in their question, I'll let you know when there's a question as well.
Okay, then, good. Okay, so we're just gonna dive into it straight, and like I kicked it off. I said basically we have to look at the accounting. I mean, what basically is the essence? Why do we need to actually capture our records and have accurate information at the end of the day? And I've kind of displayed it on the screen here, where what we're talking about is we need to do this. It's critical for our business because we need to do it for record keeping. You need it for analysis, for budgeting and tax purposes. Now I'm still going to go into each individual headings as we go further in the presentation, but I'll just run a quick scenario. If you have if you're expending amounts on daily basis and you do not have track records of what you're expending, if you do not capture that information adequately, you may overspend in some cases, and that could even lead you into, by the time you're trying to do a costing for your product, you could actually not have proper information. And again, the way you classify the information that you have in terms of the headings and the accounts that your chart of accounts also help you in terms of when you're going to submit your tax. There are so many tax um, cuts and avoidances that you can actually achieve if you are able to actually have your records properly presented. It also even reduces the time you spend with your tax consultant because the information is given to him in bulk. He can now be the one that will now do the analysis that will actually enable you to actually achieve a good a good returns in terms of when it gets to your taxes. And then you now go into, we could then even just quickly talk about budgeting, which we would, like I said, discuss in details in other slides. But how do you even know how to prepare for what you are about to embark on? You need things like cash flow. You need to understand how you're going to be able to know how much cash you would need. If you run out of cash, what's your fallback plan and all that. So if you don't have this information, you can already you can already see a picture whereby you're going to start having issues down the line. A lot of people keep information on spreadsheets. A lot of people keep information in shoe boxes. You put your receipts in shoe boxes, but technology has gone past all that. As of today, you can take pictures of your receipts and store them in the cloud. You have accounting softwares that you can actually use, like KIPPIN, that you can actually use to actually capture all the information that you need, and then it pulls out all those reports for you at the end of the day. So if we then look at it, what's basically accounting? Accounting is when you actually do keep records, but there are principles to the way the records are being kept, which has to meet certain standards. You have to actually put your records in a way that is interpreted by accountants, bankers, and anybody that wants to read a financial statement. And so what I did was just to try and explain the basic fundamentals of how do I keep my records. Now, for accounting, you every transaction has what I call two legs in this case, or you have to actually have two entries which you're going to keep. And that's why it's broken down into debits, and then we have the corresponding credits or vice versa. Accounting strictly works on the principle of double entry, and that's why you hear the word balance sheet. If the left side, which is usually the assets or the liability, we cannot outweigh, um, must balance with the assets. If it doesn't, then there's something wrong with your accounting. And you also there are also different kinds of accounting methods. There are two basic. There's the accrual method, and I'll explain it, and also there's the cash method. And so that's another thing you actually have to also capture. With the accrual method, you are capturing the information from the get-go, from when the transaction actually takes place. That's from invoice until payment. But with a cash system, you're actually just doing from payment, then you make a record. So with accrual system, immediately you do a transaction, you raise the first line. Apart from the contracts you would have raised, you raise what is called an invoice, even though you've not gotten payment. The invoice at that point in time will say, I have made this transaction, and this is the person that is owing me. So you can see at that point, there are two entries. Immediately you do that, you're going to have your debtor, and at the same time, you're going to have your sales. Now, when you get paid, you do another two entries, which is then you hit the bank account, and then you also hit the debtor. That means the debtor that was owing you has paid, and it becomes nil. So even if you close your books at that point in time, you will notice that you have sales and cash because you've eliminated the debtor, because the debtor was owing you and he's now paid you, so it's a zero, but your sales and your cash still remain. Now, the reason why I went that route is so that I can explain to you that the last entry is what people see and they think that is a cash records. For cash records, you only come in at the point, you do not record your debtors. You come in at the point where I made a sale, the guy has paid me now, and usually that works better for people that do cash and carry business, who do not have any debtors to carry on their balance sheet. So everything you're doing is like a cash and carry business. So the cash comes in, you get paid, and immediately you hit it to your sales. You do not capture records in between. So the accrual method is what allows you to be able to look in future, who do I owe, who owes me, and you are able at the same time to be able to send invoices, receive invoices. You have what is called your AR, accounts receivable, and you have your AP, which is your accounts payable, which you also get to monitor, because accounting allows you to see those pictures when you go into your records to know who you owe and who you're about to pay. So that also goes to the aspect where we talk about the inflows and the outflows. It's still the same thing. The inflows will have the debit or the credit, and the outflow will also be a debit or a credit in this case. And there's also like a slang which we use in the accounting world, which is that in the accounting world you credit the receiver and you debit the giver. Okay, so I'll move on to the next slide. And this is where we talk of which I have already been explaining before. There's the part of the benefits of accounting, right? Once you've able to capture the information of a transaction, this then become records. With that, you can analyze these records. You can use these records to plan. You can then, at the same time, also look at the trends that your business has been following. So, um, if, for example, you're spending a lot, say you're spending a lot on some items, and you're not capturing the information properly, what you will find at the end of the day is you're going to find out that you're not able to monitor your cash flow properly. And at the same time, you're not able to actually confirm what is actually the cost of your goods or what are your overheads. So I'm going to give some examples in our discussion here. What I look, the first one we'll look at is, I said, how do you know how much cash flow you have without bookkeeping? Cash flow is actually a record that takes all the information of your cash that comes in, all cash that comes into your business, and all cash that leaves the business. You can monitor this in terms of, you can have it on a spreadsheet, or you could have a system that will generate that information for you. Cash flow has to do with every form of cash you have. So whether you have a line of credit, for example, or you're going to borrow money from someone, those are all the information you can add to a cash flow. But if you do not have a cash flow that shows you the information about what you're doing, you may get to a stage where you actually could run out of cash. And that is where, at that point, do I loan more money? Do I borrow more money? Do I go into my line of credit? But you need that information, because if you're monitoring your cash flow properly and you're imputing all the information of expenses and inflows you are getting, it lets you know at what point in time you may run out of cash. If you if you have a business whereby maybe it's a business where you're constructing something, for example, and your payment is not going to come at the end until the end of um, the transaction, you need to know if you're able to pay your workers. You need to know how much cash you have available to pay them. You need to be able to understand that it's going to get to a stage where the cash you have may run out, or you need to monitor the trend. Maybe something that they're supposed, you find out that you're paying more on in terms of labor, or you're paying more in terms of materials. It's this information gets captured in your cash flow. It also gets captured in your um, profit and loss, but the cash flow is the first thing that you kind of monitor regularly on daily basis, to actually, when especially when you're doing projects. If you're not doing project, if you're just into the business of buying and selling, it's easy to actually monitor it more from your profit and loss. But if you're doing construction, things that have to do with long-term projects, it's always best to use a cash flow to actually monitor it. Accounting also helps you to determine your liabilities and assets, because there are certain times we look at it from the point of view that a property is an asset, but it's actually a liability. And I'll give a quick example. You buy a car, for example, and that car is just a car you drive from home to work on daily basis. A lot of people will say that is an asset, but you have to look at it from the point of view that you're spending more money on that asset. It's not generating income.
And I had a question about that too, because I've had contracts before where I didn't price it properly. And then at the end of the year, you realize you're in a big deficit. So, what kind of suggestions do you give for, especially people that are pricing their products or getting contracts and trying to price it for like group? For us, it was like a bigger volume. So, we reduced our pricing, but we reduced our pricing too much. How do
Yeah.
you work with clients to figure that out?
The best thing, like I said, is if you had something that showed you like your, first of all, you have to design what is called like your cost of goods, right? You have to take into account every component that makes up part of the cost of goods. Whatever it is, even up to the stage where your personal car that you're using to maybe run around to get to let's say you're in the construction business now, and you have a truck, and you're using your truck to drive to Home Depot to buy things, put it in the truck, bring it to the site, and do the construction. That's a cost on its own, because when you look at what is called an opportunity cost, if you did not have that car, you would have rented the truck. If you rented the truck,
True.
you would have been able to capture the picture that, okay, I have a cost at that point in time. But you driving your truck from Home Depot to that site, you don't bring in the cost, but you buy gas into your truck at that point
Yeah,
in time.
and the thing that crushed us was not factoring in payroll, remittances, and HST.
Yeah,
So usually, like, how do you, because you put the price to say to cover your, what's it called, like your employees.
yeah.
So how do you typically work with a client to then adjust for the additional costs of your employees, or like, let's say, the tax?
The cost of employees, if it's, for example, you're selling a product, right?
Mm-hmm.
You have to look at, am I paying commission? That's a direct cost to that product. Am I paying somebody who has to, like, somebody who is even securing the warehouse? That's a cost directly affecting that product, wherever you're keeping that product. Cost of security, you have to be able to apportion that amount onto whatever billing that you're going to give to the customer. But if you've not captured all that information at the beginning, before you started the product, then you're going to guess. You're going to say, oh, um,
Yeah, exactly.
exactly. Yeah. So what do I need this? Do I don't I need this? But if you've looked at it from the minute, say somebody says, "Oh, we need you to supply, you know, toilet rolls, for example."
Mm,
You know, you immediately have to start looking at it from the point: what's the cost of transportation? What's
mm,
the cost of the person who's going to go buy those goods? What's the cost of me getting those toilet rolls to my warehouse and holding it? And there's even the holding cost, because you've spent money. Don't forget that the minute you go and buy those goods, you've expended money. And the guy says, okay, don't supply till 30 days. What's the cost of holding those goods for 30 days?
okay.
So Tunji, is your recommendation that you sit down with your accountant before, obviously, when you start a business? Because most people see the accountants at the end of the year,
True.
not at the early, at the when they start their business. And, these kind of conversations seem like conversations that should be had with the accountant even before you kick off. Yes, the platform is going to support you, and we can do that. But the actual conversation with your accountant to map out, well, what's your cost of sales, what's your delivery model, etc., needs to be had earlier, not later.
Correct. You need that. But let's even look at it from the point of view that you haven't even engaged an accountant.
Hmm.
The information you can look at on your accounting software will even nudge you to ask yourself those questions. Because if you spend money immediately, your debit card gets hit. If you took cash out of the bank, immediately you can see it in terms of a cash flow. Immediately you can see that, okay, the other day I gave X $200, to go hire a car, go to the warehouse. I'm using the toilet roll expense.
Hmm.
You know, I spent that money. So in accounting, you've captured that $200. Now, when you sit down and you say, okay, I want to actually look at the invoicing steps, right? Those costs that you've already captured would allow you know that you already have those amounts expended, and then it will trigger you to kind of factor it in. An accountant, yes, when you sit down, for example, if you sit down with me, those are the first kind of questions I'm going to ask you.
Mm.
What are your cost of sales? Now, a non-accountant will say, well, I don't know what the cost of sales is. Then we'll break it down. Okay, what does it cost you to get these goods manufactured or purchased? What's the cost of resale? What's the costs, all the associated costs? You tell me every step you need to take before those goods get to the customer.
Well, and I think that's where that conversation is so key, because, yeah, I could be looking at my income statement or my bookkeeping and seeing, okay, I need to clean a car, and the person cleaning the car is going to take a half an hour. So that
Yeah,
half an hour is X amount. And so I'm going to charge to clean this car Y amount.
correct.
Then the conversation pulls out the intangibles, where And this comes up a lot with clients that we work with that make things, like they either design clothing or design jewelry, and they don't factor in the actual time for themselves of doing the work.
Exactly.
They just figure out, oh, I need these 10 supplies and I can make 5 gadgets, and so I'm going to price it at the cost of my supplies. So the comment is very key, that the conversation pulls out a lot of the intangibles.
Yeah, and that's a very big mistake that small businesses always make. The owners never pay themselves. You know, they do not look at it from the point of view that their time. They look at it more like, okay, when I make the money, I'm not saying that you have to charge exactly what you're worth at that point in time, but let it be on record, because you see that cost is a cost you can write off on tax. You may not make the profit, but it's a cost that the tax man recognizes. So, I'm not saying that you're going to go and cost your hours $1,000, an hour. Maybe you're creating something. No, but what is going to be the reasonable cost that you can add? The time you spend for making that product. You're also, if you're directly involved, those are costs you can add. Now, the way an accountant the way he will turn it out at the end of the day is, he may actually show you that you did not make profit on that product, but you actually you gotten what is called inflow, which can help propel your business the next time you're going to do that same um, contract the next time with somebody else. The first deal you get may not be the one that is going to, you're going to totally break even, but it allows you see the accounting allows you see the picture of what that thing is actually worth by the time we do the actual costing. That means you capture every aspect of the cost of creating that good before it gets to the end user.
Yeah, it'll help you say no.
Yeah,
Like sometimes it's a contract that you just shouldn't
exactly.
even take.
Because yeah,
I appreciate
because another thing which if you notice, I said on the screen, I said cash flow is not the same as profit. That's another mistake a lot of people make. You find people that the minute they start receiving huge cash inflows, they say to themselves, "Oh, I'm making millions. That's not profit. Your cash inflow, you're first supposed to deduct your cost. After you've taken out your cost, that is when you can actually say the net is what is called profit. So if you haven't taken out the time you spent, if you've not taken out electricity, you're running an office, you've not taken into consideration the rent, you've not taken into consideration interest on the funds you borrowed, if you had to use funds, then you actually don't have a profit at that point in time. All you are getting at that point in time is inflow payments. You're receiving payments. So your first thing you need to do is, what was the cost associated with creating this product? Then whatever is left is actually what is profit. So you first pay off all the things that created the product, which you incurred cost on, and then whatever is net is actually what, and that's why accounting created the net profit or the net loss. So at the end of this product, did I make money, extra money, or did I not make extra money after I sold the product? Like you said, the example you gave, you said you forgot to add employees. And of course, those employees, you were paying them regularly while you were trying to do the transaction. That has to be factored in. And that is where accounting.
Yeah, and not even just the employees, it was like the remittances. So having to match their EI and CPP, and you're withholding from their earnings, their EI and CPP.
Yeah.
That wasn't in my income statement. It was just like, so you do the whole calculation and you get your net profit and you're like, oh yeah, if I charge X, I'm going to have this profit. But there's additional remittances that eat away at that profit. So you're actually at a loss, but you don't see it right away. That's kind of something that came after a year when you're calculating everything and you realize you owe a bunch of money.
But that's the thing now. The good part about it is that it came after. And the only way you could have seen it is somebody later then captured that information, maybe your accountant, and now said, you are still owing this.
Yeah. So who, like, is there a certain type of accountant that would be good to pull out those kind of intangible costs, or generally any accountant should be able to have these kind of conversations with you?
Generally, every accountant should be able to have the basics, but there are also accountants that handle startups, handle strategies, for example. Then those are the people you would refer to as your financial analyst. You know, those are people that could help you, look at the big picture as it is. Some accountants just focus on just bookkeeping. So what they're doing is they're giving you records of what you've spent versus what you earned. So you have accountants that will sit down and look at, am I actually making a profit in this case, or are there still costs that are inside that associate with this product that I have not brought into light? So, but one of the first things is at least even capture the records that is actually part of the business. Once you capture the records, then part of the presentation as I go on would be, then I'll be explaining uh, things like financial analysis, budget, and planning. Okay, so like I had already said, part of the benefits of accounting, basically, it would allow you to take full advantage of tax rebates, right? It's one of those key things. Like I said, if you don't bring in your cost as the director into the business, that's a cost that you can claim back with the tax authorities. But if you've already added your cost, even if you're not physically getting a salary, you can actually still say create what is called like a director's account and say, okay, my cost associated with this business is X. I get paid X. But of course, a tax consultant would also tell you you have to look at the cost and benefits. Do you want to pay through the business or do you want to pay it as an individual? So you need to also balance that out, because once you say you're earning a salary, for example, then you have to pay your personal income tax. So there are two ways they can get you. But if you're able to at least be able to get enough rebate from your business, then you can offset it against your personal income tax. Those are getting deep anyway. Um, Another thing, like I explained, is budgeting, right? It's very, very, it's planning. This is when you're planning in advance. You're saying, how much are we going to need for next year to be able to run this business? How much are we, well, for the period this year, even to run this business? Budgeting is also always based on a lot of variables and factors. Because, say, for example, people that budgeted in January never took into consideration COVID-19. I mean, this would have wiped up any. People may have provided for it, but for business to totally go to zero, those are the kind of things you may not be able. But even even with that, accounting helps you capture the cost that you're still incurring, even though you're not getting any income. That's the part, because you're still spending money, maybe whether you're spending rent, whether you're keeping electricity on, you have security in the place. Those are the things you're going to capture. And at the same time, it will now allow you, after such a period is over, you need to now know how you're going to recoup those kind of expenses. you know I've also explained it in terms of your personal expenses versus business expenses. There's such That's one of the things I always help a lot of small business when I talk to them, is there's such a blurred line between the two, especially small businesses. You, all you have on your mind is you want to sell your product, you want to have good quality, and at the same time you want to make some money for yourself. So a lot of people do personal things, use their personal um, people work from their houses. People use their cars to do a lot of things. I had a friend who he packages things. He uses his kids to help him. When he has downtime, he'll get his kids into the basement. They'll help him. And I always ask him, you don't pay those kids. They are part of your, because if you had contracted that out, so that's the picture. I always want people to look at it from, if I had contracted it out instead of using my personal, what's the average cost I would have incurred? Like I said, you don't have to put everything, but at least even capture an aspect of it. If you had contracted it out, say maybe you would have paid $100. Even if you say, okay, I'm going to allocate $75 as the cost of packaging, for example, or design or whatever, that's still a cost that you can justify on the long run. But those are things that are not visible until you finished the product and you've even sold it. Then you're looking at things from you know hindsight, and you're saying to yourself, I did not even factor this cost into this business. I did not even take into consideration the fact that these are things that if I contracted out, I would have incurred such expenses. I gave the example of using your truck to move lumber, for example, from Home Depot to the site. If you had employed uh, a transport company to do that, there would have been a cost. So, and as I said earlier, in today's world, you don't need to actually manually keep those things. You know, bookkeeping the way it was in the olden days. Yes, it was. They had to, we had to use things like ledgers and calamazoos and things like that to record transactions. That's why it's really called bookkeeping. Maybe today's world we should call it computer keeping or cloud keeping, accounting, because everything you can do now with a click of a button. For example, with the keeping software, if you can take a picture, you can do accounting, because all you need is a copy of your receipt. If you have a copy of your receipt and you're able to take a picture of it, it goes into the clouds, and in the system is able to help you do what is called a classification. If it knows that it's from you, maybe you eat at a particular restaurant every time for business, it can help you classify it as business lunch. And if you use your credit card, if you use your personal credit card, it will charge it to directors. So that is like directors kind of using his money to kind of fund the business to go for a business lunch. It captures that information, that's a cost. And at the same time, it shows that the director has infused a little bit more money into the business. So you can have an account where you are able to see those kind of information, that things you do. There is also the part where you go into Staples, for example, and you buy paper for the business, and then you take maybe 2 bundles for your kids at home. There's a way you can do what is called split. You can split that bill. Even though it came from one source, you can split it. And those are the kind of features the accounting software like KIPPIN offers. You can split that bill. So it lets you know that maybe 2 packs of this whole box that you bought was used for personal, and the remaining 10, maybe you bought a dozen, is for the business. So you are able to actually split those costs between what's a business cost and what is actually a personal cost. And those are things that the software helps you, just as long as you can just take the time to capture that information as at when it happens. Do you have any questions here?
I was curious, are you going to do maybe like show the software?
Yes.
I wasn't sure.
My aim was to show it at the end.
Okay.
So
yeah.
my aim was to show it at the end. Or and so I'll just go again into still talking about bookkeeping best practices, right?
Okay, great.
So I have I would on the screen you can see things like what bookkeeping, one of the best practices, what it helps you do is, which is, I just explained it, it helps you keep your personal and business finances completely separate. That's the thing, because the system sees you, the government sees you the owner as an individual separate from your business. Even if it's a mom and pop shop, even if you run both, when you run when you run your taxes, when you prepare your taxes, the income you make on the business, which you classify as for business, you can write off expenses against that business. But as an individual, you cannot do that. As an individual, you're just going to pay the payee tax, and they're going to deduct. Okay, you've deducted. Say you're working. I work for an organization. The organization pays me, nets off my pay, and takes away my um, the tax remitted to the government. At the end of the day, the government is just going to check as an individual, did you pay the correct tax based on all the parameters that are necessary? You cannot write off anything. The beauty of a business is when you have a business, anything that pertains to you generating income, you can actually write off against the business. If you purchased paper, if you hired somebody to help you do something, all those things can be written off against the income. And so that's where bookkeeping helps you kind of do create a clear-cut line between the personal income and business income. You know, it also determines, like I said earlier, on which accounting method you want to use. Do you want to capture your income at the point where the transaction takes place so you don't forget? Or if you're the kind of person that, okay, I only want to capture it when they pay me, you know? But usually the cash accounting method is actually, fizzling out because it kind of, it's working on the parameters that you would always remember. But if you use the accrual system, the system reminds you at every point in time, especially with, like I said, with accounting softwares that can allow you to look at um, who is owing you at any particular point in time, even when you can't remember those things. If you do the transaction from onset, you'll be able to, you know, you'll be able to now remember that I did this transaction and this is the amount I'm supposed to get at the end of the day, and these are the people that owe me and that they're supposed to pay me. Versus a cash system, if you do not create an invoice, you know. So that's one of the key elements also in accounting. If you're able to capture the transactions immediately, the transaction takes place. Then again, we look at what we call the chart of accounts. Your chart of accounts is actually your account headers. So your chart of accounts is there are buckets that keep all those information, all those transactions, and break them down. So you have things like employee expenses, that's an account. You have things like stationaries. You have things like telephone expenses. And under even those chart of accounts, you can still even break them down further. For example, if you have telephone expenses, you can have CEO's telephone, you can have contractor's telephone. So your chart of accounts is what the accountant can now use at the end of the day to actually um, create a proper analysis. Because if you keep everything, say, for example, on the telephone, you're not able to see the full picture. But if you've broken it down, then you're able to see that I have 5,000 I incurred on telephone. It's able to tell you that, oh, the salespeople spend more on telephone. And that's an area where you can actually go and zero in. Why are we incurring so much? Are they using the telephone for personal purposes? And those are the kind of information that a chart of accounts can actually spool out to you, because you're capturing itemized information under the charts of account. So you're able to see it at a glance. And a chart of accounts, which can also be looked at when you have information, it's called the trial balance, can give you all that information at a glance. You can see all the costs associated with each account.
Yeah. So Tunji, quick time check. I think we have about 15 minutes left, and I know you want to show just very quickly what the application looks like, and you've got a couple more slides to go through. So I don't know how you want to handle it. You just want to walk through the next rest slides quickly, and then go through, show
Okay.
what the application looks like, or?
Okay. I thought it was 2 hours. I had the impression it was 2 hours. Okay. I think
Ryan, do we have 2 hours or an hour?
No, we're gonna go till 6, and then time for questions.
Okay.
Oh,
Yeah, so
okay.
it's an hour.
Okay. Then Carlos, would you be able to help me get the chart of accounts, the account software ready? Because I don't have mine open now.
Okay, so Coco will show the mobile, and I can show the.
Okay.
Yeah.
Okay, so I'll run through. Then the next thing is bookkeeping also helps you with internal controls, and basically, like I just said, now it allows you capture the expenses, the ones that are actually going out of control, that you can actually know where you're bleeding. Um, with bookkeeping today, you can capture all your information, you can track them on softwares, you can track expenses, and at the same time it helps you manage your accounts payable and account receivables. And it also allows you to do reconciliations. Reconciliations is where you're trying to find out how much you spent in the bank, because there are times you give out a check, but you're looking at your balance and it's still showing you that the amount is there. The person has not cashed the check. Such informations you're able to do a reconciliation that I've actually spent the money, but the money is still in the bank until the person cashes it. It allows you to create your monthly financials, to be able to do your data evaluations, and also handle your taxes. And then at the same time, when you have good records, it provides accountability for you. You know, um, if we run through record keeping, we'll just look at it from the point of view whereby it helps you, like I've already said, most of these things to manage your cost, to improve your business. And the informations that you keep could also be for legal purposes or for tax purposes. And it actually, all records that you keep actually contains all informations that help you know how your business is performing, how you've been running the business. And at the same time, when it comes to providing evidences and informations about things you've done, you can always find them with record keeping. You have different types of record keeping. We've been talking about the accounting part. You have bank statements, you have legal documents, you have permits and licenses, and all those insurance. Basically, one of the best things that bookkeeping helps you do is it gives you that accountability. It allows you accessibility, compliance. It keeps integrity of the records, protection and transparency, retention, and also at the same time the position. um, Taxes here, which was, remember where you mentioned about HST. Something you always have to know is that the government now, every business you do that falls under the HST, you must register your business. That's the first thing. To be able to, once you have an HST number, then it allows you to file your taxes with the government. Now, you are not the person as a business paying the HST. The customer is the one paying the HST. It's actually a form of withholding the funds and paying it to the government at the end of the day. But you also have to remember that HST comes with what is called the input HST and the output HST. Input is when I bought the goods, I incurred HST. When I'm selling it, which is also going to be at a markup, the HST there would definitely be higher than what I bought it. You have to do a net off. You pay the net HST. If you don't have a system that is able to capture this information, you may just be sending HST to the government without actually taking into consideration the HST you paid, you incurred to actually have purchased those goods. Um, I said earlier also, the balance sheet has basically two sides which captures information. It allows you on the asset sides to know what you have in your cash and your bank, your loans, and investments. If you've borrowed money, if you're using money to make investments, you have account receivables. And then on the other side, it shows all the liabilities. And this this is the reason why it's called a balance sheet. Is your assets must always equal to your liability. And you can also are heavier than your assets, then that kind of business you can say is skewed in that kind of case. You know, ratios help you at the same time, which is what you use to determine trend analysis to be able to understand how your business is performing. But first, you need to have records and accounts to be able to even determine how your business is actually performing. This is also just explaining your assets and your liabilities a little bit further to, let how income, when you generate income, what assets allowed you to generate that income. That is what you refer to as an asset. And then your liabilities is what are those obligations that you had to incur also to generate that income, you know. And then we talk about the profit and loss, which I explained earlier on, which is when you look at your revenue versus your expenses. You know, like I said, not all cash flow is profit. You have to capture all expenses that could ensure that you are actually costing or getting a proper net profit. You have to make sure that you do not do wrong classifications of account. If you classify something as stationary, something that is stationaries, you go and classify it as utilities. Those are things that could skew your budgets in future when you are planning, okay, how much do we need to run the business, or even in terms of tax, because some things may not be tax. If you can't write, if you some things they do not allow you to write off in tax, and if you go and classify items under it, you may just be losing out on the long run. um, Reports and analysis, basically, what reports would allow you to do is to be able to actually to be able to analyze your performance so far. What have I done in the past 6 months? How did I perform? What's the what's the things I need to keep my eyes on? For example, I'll give you an example where people have obsolete stock. You buy things you want to resell, it's not moving, you keep it in the warehouse, it's on your balance sheet, you're looking at your assets that I have a lot. Oh, I have assets, but those things are becoming obsolete. They could be things that are time sensitive. If you don't have the picture to review your reports and look at the analysis, you're not able to say, okay, we have 20,000 in stock. What's the breakdown of this 20,000? Those are the kind of things that reports will help you achieve, because the reports would have captured every individual item. You're able to also do analysis like a trend. Which goods are moving? Which ones are slow? So when you're planning in future with your team, you're able to say, let's focus on this product. This move faster than this product. Let's make less of this. Let's make more of this. Those are the information you're able to actually capture. Then you come to budgeting, which I had explained earlier on. It's one of the things that actually help you to control your finances, because it allows you know where you're overspending and what you should expend. Say you want to do a budget for next quarter, you could do your budgets annually or you could do it quarterly. It allows you know, um, in a budget session, you would have estimated how much you're going to sell. So if you're not selling, what are the reasons for it? It helps you. I mean, like I said, it keeps you honest. It lets you know, am I doing what I should be doing to achieve these results, or are we just, when it comes to budgeting session, what you find out is the salespeople who spend a lot will be the ones that will say we can sell 1 million. But as you're monitoring it, you're able to see budget versus actual. Are we meeting our targets? It also creates a form whereby you know how much debt you're in and how to avoid it, so that you do not create a big hole for yourself in future, you know. And I ran through all that. So if we have questions, we can then.